Here is the number that should make every investor sit up. Global data center electricity consumption is on track to reach roughly 448 terawatt-hours this year, and it could more than double by 2030. In the US, data centers may jump from 4.4% of total electricity in 2023 to somewhere between 6.7% and 12% by 2028. That is not incremental growth, it is a structural surge, and it ends nearly 2 decades of flat electricity demand. Two stocks are being positioned as direct beneficiaries. Constellation Energy owns a large nuclear power fleet, providing around-the-clock zero-carbon power. GE Vernova builds the gas turbines, grid hardware, and nuclear steam turbines that deliver that electricity. Today we are looking at which one actually wins from this power crunch. Constellation has moved from utility to AI power partner. On November 3, 2025, reports detailed Microsoft's 20-year power purchase agreement to restart the 3 Mile Island Unit 1 reactor. More recently, Constellation's second quarter adjusted earnings came in at $2.55 per share, beating the $2.33 estimate, and full-year guidance was raised to $11.50 to $12.50. GE Vernova's story is equally aggressive. As of August 23, its backlog stood at $176 billion, and in the first half of this year data center power equipment revenue hit $5 billion, more than double what it earned in all of last year. But on August 24, Jim Cramer warned that political and community backlash over power costs and water use could shift the winners away from equipment suppliers toward big tech hyperscalers. Markets are pricing both as growth stories, but differently. Constellation trades around $273 with a $97 billion market value and a modest 0.61% dividend yield, reflecting its contracted nuclear cash flows. Its fleet ran at a 93% capacity factor last quarter, delivering 44,160 gigawatt-hours. That is exactly what hyperscalers want: baseload, always on, clean electricity. GE Vernova has returned over 42% this year and is up 194% since the start of 2025, but it trades on a forward price-to-earnings multiple near 67 times. That means investors are paying for several years of flawless execution. The risk for GE Vernova is its wind segment, which has been a drag, and the possibility that tighter regulations slows data center build-out. Looking ahead, the immediate catalyst is hyperscaler spending. Constellation CEO has said projected 2026 hyperscaler spending is nearly 75% higher than last year and still being revised upward. Constellation has already signed long-term nuclear power purchase agreements for 920 megawatts with investment-grade customers, starting from 2029 to 2032. On the grid side, investors are watching PJM's March 2027 framework decision on data center connections. If that framework is delayed or restrictive, equipment names like GE Vernova could see orders slip. The broader political risk is real. Local opposition over electricity prices and water consumption could push American data center growth to new regions or delay projects. That does not kill demand, but it could compress the premium valuations. The data center power crunch is not a short-term theme. It is a multi-year rewiring of U.S. electricity demand. Constellation offers lower-risk exposure to nuclear baseload with contracted revenues. GE Vernova offers higher growth exposure to the hardware layer, but with a richer valuation and wind segment risk. If you believe AI capital spending continues, both can work, but the risk profiles are very different. Know which one you are actually buying before you open the position.